Welcome to The Explainer. You know that piece of plastic you carry around everywhere? Today, we're going to pull back the curtain and find out how it really works. I mean, think about it. Millions of us use them every single day. We barely even think about it. But what's actually going on in those few seconds between a swipe, a tap, a click, and that sweet, sweet approved message? Well, it's a surprisingly complex little dance. Okay, so here's how we're going to break it all down. First up, what even is a credit card? Then we'll meet the 4 key players in every transaction and get into the rules of the game. After that, we'll talk traps versus rewards, how to win, and finally, we'll connect it all to that super important number, your credit score. All right, first things first, let's lock in the single most important idea you need to get because everything else builds on this. Okay, here's the core truth. It's not your money. Seriously, when you use a credit card, you're actually borrowing money from a bank. They pay the store for you, and in that moment, you've made a promise to pay that bank back. You can kind of think of it like this. The bank is extending you a line of trust. They're basically saying, hey, we trust you. Go ahead and spend up to this amount. Just pay us back later. The whole system, literally the whole thing, is built on your promise to do just that.
So if it's a loan, who's actually involved here? Well, it turns out there are 4 key players in every single transaction you make.
First, obviously, there's you, the cardholder. You're the one kicking the whole thing off by deciding to buy something.
Then you've got the merchant. This is just the store, the website, the coffee shop, whoever you're buying from. All they care about is getting paid, right? Player number 3 is your bank. This is what we call the issuer. They're the ones who gave you the card and are fronting you that short-term loan we mentioned. And last but not least, we have the card network. Think Visa, MasterCard, Amex. Now, these guys aren't banks. They're more like the messengers, the super fast communication highway connecting everybody else. They make sure the whole system runs smoothly.
So here's how it all clicks together in like 2 seconds. You swipe your card. The merchant's terminal sends a request to the network. The network instantly pings your bank and asks, hey, is this person good for the money? Your bank checks your limit, and if everything's cool, it sends back an approved. The bank then pays the merchant. It's wild that this happens so fast.
Okay, so now we know who's involved. Let's talk about the rules of the game. Because trust me, understanding these is absolutely crucial if you want to use a credit card the right way. One of the biggest rules is something called credit utilization. It sounds complicated, but it's just the percentage of your total credit limit you're using at any given time. And here's the magic number. Experts say you really want to keep this below 30%. Go higher than that, and it can start to look like you're a little overextended, which, yeah, that can ding your credit score. Everything, and I mean everything, runs on a monthly billing cycle. So for about 30 days, you go about your business making purchases. Then at the end of that cycle, you get a statement that lists everything you bought. Now here's the good part. You get what's called a grace period, usually around 20 days or so, to pay it all back before they start charging you any interest. But what happens if you don't pay off the full balance by the due date? Well, that's when interest kicks in. And oh man, credit card interest rates are no joke. We're talking averages around 24%, sometimes way higher. This is the #1 way these companies make their money, and it's exactly how a little bit of debt can spiral out of control. But see, knowing these rules, that's your superpower. It lets you dodge the common traps that are kind of built into the system and actually make the card work for you instead of the other way around. And that brings us to the most important choice you have to make every single month. Pay your balance in full, and guess what? You pay $0 in interest. That loan was basically free. But if you only pay that tiny minimum payment, you're walking right into a trap. It's a trap designed to keep you in debt for years, just racking up massive amounts of interest. And it's not just about interest. You gotta watch out for fees too. You've got annual fees, especially on those fancy rewards cards. You've got late payment fees if you miss a due date, foreign transaction fees if you travel. All these little things can completely wipe out the value of any rewards you think you're earning. Okay, let's wrap this all up by connecting it to that 1 3-digit number that has a huge, huge impact on your financial life, your credit score. See, every single thing you do with your credit card is being tracked and measured. The biggest things they look at, your payment history. Are you paying on time every time? And that credit utilization number we just talked about. Other stuff matters too, like how long you've had your accounts and the different types of credit you have. So why should you even care? Why does this matter so much? Well, because a good credit score is basically a key that unlocks a better financial future. It's what lenders look at when you want a mortgage or a car loan.
It determines the interest rate you'll get. It can even make the difference in whether or not you get approved for an apartment. So if there's one thing you take away from all of this, let it be this. A credit card is an incredibly powerful tool. I mean, used the right way, it can build your credit, it's super convenient, and you can get great rewards. But, and this is a big but, it is not extra income. The second you start treating it like free money, the tool starts using you. So really, the big question isn't just how do credit cards work, it's how are you going to make them work for you?